Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 28 and the topic for today's discussion is common size and index analysis. This topic basically come under the umbrella of financial statement analysis, where we do common size and index or trend analysis of the company's financial statements. The outline of this lecture comprises of the discussion related with common size analysis, in which we will cover the balance sheet common size analysis and as well as income statement common size analysis. And then at the last portion of this lecture we'll cover the index analysis, which is also known as trend analysis in financial statements analysis topic. Here once again we will discuss the balance sheet index analysis and as well as income statement index analysis. What is a common size analysis for a financial statement? This type of analysis is actually related with calculation of the percentage financial statements. We can narrate it as an analysis of percentage financial statements where all balance sheet items are divided by total assets. For making common size analysis, we are required to divide all the head of accounts available in the balance sheet with the total asset amount. And similarly, for an income statement item, or for making common size analysis for income statement, we are required to divide them by net sales or revenue of the company. Let us take an example of basket wonders to make common size analysis for balance sheets. Dear students, we have 3 years of data pertaining to the basket wonders balance sheet, which belongs to 2005, 2006 and 2007 data for basket wonders balance sheet is available in the first 3 columns, and this column, leftmost column, narrates the head of accounts available in the balance sheet, which are cash, account receivable, inventory, other current assets, total current assets, net fixed asset, long-term investment and other long-term investments. Now, how to make common size analysis? As the definition has stated that to divide each item of the balance sheet by total assets and then multiply it with 100 will give you a certain percentage. This right hand side, which is common size percentage, narrated at the top of the right 3 columns for year 2005, 6 and 7. How does the particular percentage calculated by the financial analyst? Let's discuss one of that. In year 2005, in order to reach at 12.10%, according to the common size analysis for the balance sheet, we are required to divide the relevant accounts value, which is 148, by total assets and then multiply it with 100 will give you 12.10, and then you can write it in the common size analysis section of this question, which is 12.10%. The percentage sign is not available because we have already narrated this percentage sign at the top of the 3 columns. Now let us discuss how the long-term assets of 2005 are calculated. Other long-term assets. So for year 2005, once again we are required to divide the other long-term assets, which are 111, by the total asset amount, and we will get the relevant percentage, which is 9.08. So this is the way how we can make a common size analysis. For each head of account, we are required to use the same formula to divide the relevant value with the total number of assets and then multiply it with 100 will give you the relevant percentage. With the help of same mechanism, we have calculated the common size percentages for 2006 and 2007 as well. Now what does it mean, or what actually common size analysis does? It actually helps us to find out how much percent of our investment is stuck in a particular head of account. Let's suppose in 2006, suppose we have $100 of investment in total assets. Out of this 100, in the inventory section in 2006 we have 30% of this investment. So with the help of common size analysis, we can easily make our analysis that what portion of our total asset has been stuck in a particular head of account. Now let's do the common size analysis for liability and owner equity section as an example. How this value can be calculated? Let's take first head of account, which is notes payable. We can simply divide the notes payable amount, which is 290, by the total assets, which was 1223. By using this formula, we have arrived at the percentage of 23.71. It means that our total notes payable are 23.71% of the total assets of the company. Similarly, for 2006, once again the same formula was used to divide the notes payable amount, which is 295, by its relevant total assets of the same year. Actually, total liabilities and owner equity are equal to total assets, so therefore we are picking up this amount from the cumulated value for total liabilities and equity. So ultimately, with simple mathematical operation, we have arrived at 14.43%. Since the percentage sign is already been mentioned for once, so therefore we are not required to write down the percentage sign each time we are calculating the percentage for relevant head of account. Now let's discuss how we have arrived on 2007 common size analysis for notes payable. Once again, we are going to divide 290 by its relevant total assets, which is 2169 in this case, and in the yellow box we can see the simple mathematical calculation. The percentage notes payable are occupying in 2007 is 13.37%. Now, what are the benefits of common size balance sheet analysis? It actually helps the investor as well as the internal management to know about what portion of our total asset has been stuck in a particular head of account, or what portion of our liability or owner equity consists of. So it also helps to compare the company with the similar nature companies available in the industry, and as well as with the industry benchmarks, because to compare small company with the larger company is not easy if we are taking in absolute terms to compare the exact amount of notes payable or liability with another company's notes payable or liability. Therefore, the percentages are the standardized measure to compare these value within the company and as well as with the industry benchmark. Also, we can compare these percentages with the other external companies in order to know where the company is performing good and where the company is performing bad. Now let's discuss the common size analysis for income statement. Same company's income statement, the pattern is to divide each head of account of a particular year by its net sales. Now how does this cost of goods common size analysis, which was telling us 68.7% of the 68.7% is the value of cost of goods sold in 2005 for Basket Wonders company. The method is to divide cost of goods sold by the relevant sales value of that particular year, and we can come up with the percentage of that particular head of account. Similarly, for 2006, if you would like to make a common size analysis or calculate the percentage for cost of goods sold, so we can divide the relevant cost of goods sold of the year by net sale of that specific year, and this simple mathematical narration can give us the relevant or exact answer, which is telling us 71.3% is the cost of goods sold in 2006 for Basket Wonder. Now let's discuss the third year, which is 2007, and we have 72.3% cost of goods sold. How did we calculate it? We have divided the cost of goods sold of 2007 by its net sales, and we can see in the yellow box the calculation. Divide 1599 by its relevant net sales, and we come up with 72.3% of cost of goods sold. Now this is a simple formula, and we can calculate all the rest of the percentages by utilizing this formula for each year, which is 2005, 6 and 7. So we can see that there is 100% for net sales. The reason behind this is that we have divided net sale by the net sale, which means 1235 divided by 1235 multiplied by 100 will give you that it is 100%. Therefore, the first value will be 100%, and the rest of values are with respect to the net sales percentage. It means that our cost of goods sold is 68% of net sales. And similarly, we can make an analysis for interest expense in a fashion that interest expense of Basket Wonder in 2005 is 1.6% of the net sales of the company. In a similar fashion, for if we would like to make an analysis for year 2007, so therefore the percentages have been calculated by using the same formula. How can we make an analysis for earning after tax for year 2007? We can infer that the company's earning after tax in year 2007 is 4.1% of the net sales, because we have calculated all these percentages for 2005, 2006 and 2007 with respect to the net sales of the company. This kind of analysis helps investor and internal management to find out the potential problem and as well as the positive points or performance of the company inside the organization over the period of time. Like we have done we can compare 2007 percentage, which is earning after tax, with 2006 and as well as with 2005. Another way around, we can also compare these percentages with the industry's external company and as well as the industry mean average benchmarks as well. Now let us discuss the index analysis or trend analysis. What is index or trend analysis? As the name narrates, that we have to make or select one particular year as our base year, which will be termed as an index, and for the rest of the 2, 3 and 4 or whatever number of years you are selecting to make an analysis, will take that base year as a reference point to calculate the percentages. How to do that? It is an analysis of percentage financial statements where all balance sheet items or income statement items figures for the base year which you have selected, you have to equal them to 100%, and then subsequent financial statements items are expressed as a percentage of their base values. How to do that? Let's take an example of the same company which belongs to the Basket Wonder. So let's discuss what the index analysis is for the Basket Wonder's balance sheet. Once again, the data pertaining and related to the index analysis is the same what we have discussed in common size analysis. We have once again data of the Basket Wonder for year 2005, year 2006 and year 2007. This is the data initially provided to you. The first 3 columns are pertaining to the data available in a question or in a particular financial case, and this question expects you to make the index analysis of the balance sheet by keeping or considering 2005 as your base year. So now we can see the difference between common size analysis and index analysis, or a trend analysis is to select a base year. And in this example, we have selected year 2005 as our base year. Therefore, we have termed all the values of our base year into 100%. Like we have considered that cash value is 100, 100, 100 and 100, so on with the rest of the asset of the company. In the year 2006, we can make an analysis of percentages that either the company's cash position has reduced or it has increased. Similarly, what the account receivable position is over the period of 3 years with respect to year 2005 as base year. And similarly, we can see the other current assets trend as well. How to do it? Let's take an example of the cash of 2006, and the cash position is 67.6% of what? As we have calculated this percentage with respect to our benchmark of 2005. So we can infer that our 2006 cash position is 67.6% of the 2005 cash. How to calculate it? The calculation measure is to divide 2006 cash, which is 100, by the base year cash, as we have done in the yellow box just beneath it. You can see that 100 is divided by 148 and then whole multiply by 100 will give you the 67.6%. As we can see that previously in the base year our cash position was 148. However, in 2006 our cash has reduced to 100. Therefore, it has also been expressed in the percentage as well, that our 2006 cash is actually 67.6% of 2005 cash position. We can also calculate the cash index for 2007, and the cash position of the company in 2007 as per the index analysis is 60.8%. How did we calculate it? The yellow box is explaining to divide the 2007 cash, which is 90 as mentioned in the formula, by the base year's cash, which is 148. We can plug it over here and then whole multiply by 100 will give you that we have 60.8% of cash in 2007 with respect to our base year, which is 2005. So this is the way how we can calculate the rest of the values available in this index analysis for balance sheet. All the values have been calculated with the similar formula as we have used for cash calculation in year 2007. The purpose or benefit of making an index analysis is to measure the company's performance over the period of time with respect to the base year. Like for example, we can make an analysis that the company's cash position is reducing with respect to 2005 in 2006 and 2007. Similarly, we can make an analysis on account receivable. Similarly, we can make analysis on account receivable, which is stating that our account receivable position has been increased, so we can infer that the credit sales of the companies are getting increased with respect to year 2005. We can also make similar trend analysis for inventory, and we can conclude that the company's inventory position is, or the stock of inventory is increasing with respect to 2005 in 2006 and 2007. As you can see that our inventory is 191% of the base year in 2006, and in 2007 it has further increased to 216% with respect to our base year. Looking into the liability side of the same company Basket Wonder, we can also make an analysis. Let's check it out for the few values, and for the rest of the values you can calculate by using this formula. We have selected notes receivable trend or index analysis. Once again, the year 2005 is base year, therefore all the values in the base year should be transformed into 100. And then to compare, how did we calculate the year 2006? With the formula that to divide 2006 notes payable by 2005, which is the base year notes payable, and then whole multiply by 100 will give you the resultant answer, which is 101.7%. So we can infer that our company's notes payable has increased from 2005 in the 2006 year. Similarly, we can make calculation for year 2007. For, let's suppose, long-term debt we have selected this time. Long-term debt in year 2007, this is year 2007, so therefore the value of 2007, which is 530, should be divided by the base year value, which is 150 in our case, and then whole multiply by 100 will give you 353%, and then mention it in the relevant column. So this is the formula or method with the help of which we can calculate the index or make an index analysis of the balance sheets. Now let's make an index analysis for income statement. Once again, the first three columns are pertaining to the data available in the question or in a financial case, where we have selected year 2005 as our base year. Therefore, all the values are once again 100. And we have to make the percentage index for 2005 and 2007. Let's select one of the title, and we have selected this time cost of goods sold for 2006. How to make or find the percentage, which is 176.8%. How did we calculate it? We can calculate it by dividing the cost of goods sold of 2006. We can pick up this data, plug it in the formula, divided by the base year's cost of goods sold, which is 849. So you are required to divide each value with the base value of relevant column, and the resultant value is telling you that we have 176.8% of cost of goods sold. Similarly, let's select another title, cost of goods sold percentage for year 2007. How did we calculate this 188.3%? So the formula is to divide the base year's cost of goods sold, the relevant year where we would like to calculate the index value. We have to divide the relevant or expected year's cost of goods sold with the base year's cost of goods sold as done in this formula in the yellow box, and then whole multiply by 100 will give you 100 multiply this with 100 will give you 188.33% of cost of goods sold. So this is the formula or journal pattern to calculate the index analysis for income statement or for the balance sheet. What is the purpose of index analysis for balance sheet and as well as income statement? It actually tells you the trend into the head of accounts pertaining to income statement and as well as balance sheet. Like we can see that the cost of goods sold of Basket Wonder with respect to 2005 has significantly increased from 100% to 176% in 2006, and then a further increase into the cost of goods sold towards 188%. So such kind of potential threats or the cost of the companies can be analyzed with the help of making index or trend analysis very easily. With the absolute values, we cannot infer our conclusion directly that where the potential problem lies or what are the positive aspects of the company. However, with the help of trend analysis or index analysis, one can easily compare the company's performance with respect to the base year, and we can also compare these percentages of index to the other external companies pertaining to the industry to which basket wonder belong. We can also see that there are administrative expenses, and the administrative expenses have significantly increased with respect to 2005 of the basket wonder. And finally, we can make our analysis on the basis of this index with respect to the company's internal management and external management as well. Besides this, the investors and external parties are also interested to make financial statement analysis before investing their precious money in any particular public sector company. So this was all about the discussion of common size analysis and index analysis, which is also known as trend analysis, which is really helpful for the investors looking to invest their money in a particular company. It also helps the company's internal management and the board of directors to find out the potential problem or the positive aspect of the company. Thank you very much for listening to this lecture. If you have any confusion related to common size and index analysis, you are free to ask your question on KCMS or via email. Once again, thank you very much. Good luck for the day. Allah Hafiz.